Welcome to the deep dive. Today, we are stepping pretty far away from the daily news cycle.
We are.
We're going to look at something much more foundational, let's call it the architecture of American capital, but through the lens of personal power.
Right. We're diving into some really foundational texts. I mean, these are the philosophical blueprints for wealth, for success. If we're talking Napoleon Hill, Dale Carnegie.
And our mission today for you, the learner, is really a translation exercise. We're taking these big aspirational ideas.
The mental rules of the game.
Exactly, and translating them directly into concrete economic and corporate strategy. We want to find the psychological levers that actually moved finance, that consolidated capital.
And drove massive corporate power.
And we have to get to the why and the so what in plain language, because if you look at the core premise these sources give you, it starts with a, frankly, terrifying statistic about failure.
It is a high bar. I mean, they suggest that out of every 100 people starting out at, say, age 25, 98 of them will fail to clearly define their goals in life.
98.
So this whole system, this philosophy of definiteness of purpose, organized planning, persistence, it's all designed to pull you out of that massive, what they call the goalless 95%.
Okay, hold on. Let me just stop you there. That number sounds, that's incredibly high. Are these sources really saying that just setting a goal is more important than, say, specialized skills or market cycles?
It sounds almost naive, doesn't it?
It does.
But what's so fascinating is they don't deny those external factors. They just argue that the ultimate determinant of your financial status, it isn't your inherited wealth or the market.
It's something internal.
It's the development and the precise application of specific internal mental qualities. The market, in their view, is just a testing ground for your resolution.
Okay, so let's unpack that internal lever. Let's start with what Hill calls the first step, desire. And this isn't just, a vague wish.
Not at all.
He calls it an intensive, acute, burning desire coupled with a defined goal. If we translate that philosophical language into finance, what does that actually mean?
We're talking about the very first step in converting thought into its physical equivalent, which is, credit or money.
Right.
To put it bluntly, an invisible impulse is just a wish, a burning desire with a defined goal. That's a specific, measurable financial objective tied to an immediate plan. That's the moment an asset is created.
But desire by itself can burn out so quickly, and that's where the second principle, persistence, comes in. And there's really no better or more financially painful story to illustrate that than the one about R.W. Derby, the gold miner.
Oh, it's the ultimate cautionary tale. It's all about the cost of stopping. So Derby and his uncle, they find this incredibly rich vein of gold ore out in Colorado.
They've hit the jackpot.
They think so. They analyze it. They confirm its value. A potential fortune is right there in their grasp. They've done everything right up to this point.
But mining is just brutal work. They're digging deep into this mountain, and then all of a sudden, the vein just disappears.
Exactly. They hit what's called a fault line. It's a common temporary geological barrier.
Oh.
But they see this setback as the end of the road.
Their will just collapses.
It does. Their resolution is gone. They sell all the machinery to a scrap dealer for, a few $100s. They just accept defeat.
And this is where the financial lesson becomes just brutal. The buyer, the scrap man, he doesn't just scrap the equipment. He's smart enough to consult an engineer.
That is the key difference. The engineer confirms it's just a fault line. So the buyer resumes digging, pushing the drill just 3 feet from the treasure.
3 feet.
That 3 feet of persistence, or you could call it strategic knowledge, translated directly into millions of dollars of wealth. Derby and his uncle lost a fortune not because of a lack of opportunity,
But a lack of resolution, a lack of a plan for when things went wrong.
Precisely. So the case isn't about bad luck. It shows that a personal weakness, a lack of persistence, translates directly into a quantifiable financial loss. And often, it provides the capital for the next person's success.
It perfectly defines the competitive landscape, then.
It does. Who gains? The person or the company with the resolution to push past that initial failure. And to Derby's credit, he learned from this. He later applied that lesson to life insurance sales. He realized that no didn't always mean no. He credits his later massive success to just refusing to stop when the immediate sale vanished. It shows that learning to manage temporary defeat is really the prerequisite for financial achievement.
That's a perfect bridge, because if personal persistence builds a small fortune, what level of organized persistence, of sheer will, does it take to build a corporate empire?
And that sets the table for our next segment. How personality and, a really defined purpose can consolidate capital on a completely different scale.
We're talking about one of the most agenda-setting corporate events in American history.
The genesis of U.S. Steel. This is a crucial case study in translating a personal vision into a material financial structure.
So the context here is J.P. Morgan. He's busy consolidating smaller steel networks, American Steel and Wire, National Tube, and so on.
But his whole project is incomplete. It's overshadowed by this giant trust owned by Andrew Carnegie. And Morgan knows he needs Carnegie's empire to truly dominate the market.
Morgan was the brute financial force, but he was missing something.
He was missing the coherent vision. He had all these other players, these so-called financial sharks like John W. Gates, trying to sell Morgan on these vague ideas for expansion.
And he didn't trust them.
He didn't trust the ideas or the people. He needed a clear, actionable program.
And then Charles M. Schwab, Carnegie's right-hand man, enters the picture. He's invited to present his vision to Morgan and his partners at this now famous dinner.
And the setting is almost as important as the content. Schwab was given, 15 minutes to speak?
Just a quick pitch.
He ends up commanding the room for an hour and a half. And crucially, the sources hammer this home. This was not motivational fluff.
It wasn't just charisma.
Not at all. It was a clear, well-structured, completely thought-out program for a massive increase in steel output and optimized organization.
So the real asset Schwab brought to the table wasn't just personality, it was the definitive written program.
Exactly. His eloquence and magnetism gave credibility to his strategic plan. Definiteness of purpose, but applied at the scale of an entire industry. He explained how consolidation would create efficiencies, something the finance guys couldn't do. And that convinced Morgan.
Convinced him to acquire Carnegie's holdings for an immense sum.
Which resulted in the founding of U.S. Steel, the world's largest corporation at the time. It really kicked off a new era of industrial organization, one driven by clear strategy, not just brute financial force.
And Schwab's personal ability to influence his plan delivered with conviction. That translated directly into billions in capital consolidation.
Billions. Over $13 billion in today's money. It proved that a leader's clarity of thought is a quantifiable asset, sometimes more valuable than the initial capital itself.
That has powerful implications for leadership today. And this whole story seems to mark a kind of shift in business philosophy, away from the old robber baron style.
Absolutely. The sources argue that the old methods based on force and, apprehension are just economically unsustainable.
They have to be replaced.
By faith and cooperation. And this belief underpins a really interesting debate they detail about employee income sharing.
Was this seen as sort of a moral issue, a concession to labor? Or was it purely an economic strategy for the company's bottom line?
It was argued strictly as an economic necessity to maximize efficiency. The arguments for profit sharing were very practical.
Okay, like what?
First, it retains workers longer. They wait for that quarterly payout, which cuts turnover costs. Second, it helps them save automatically. Third, it boosts productivity because there's a tangible link between effort and reward.
And I imagine it makes employees more careful about waste.
Exactly. Greater economy in operation because employees start to police wastefulness themselves.
But there have to be risks. What were the pitfalls of just handing out profit shares?
Well, there were practical problems. Employees had to wait for these large lump sums, which could cause hardship. And then when the money did arrive, there was the potential for thoughtless spending, which kind of defeated the whole purpose.
Right. And what happens when profits go down? If workers are used to a share, they might resist necessary cuts because they feel entitled to that payout no matter how the company is doing.
That's the core tension. So the solution they landed on was combining these incentives with a mandatory acquisition of company stock.
Ah, so it's not just cash.
Right. This prevents the immediate wastefulness by turning that income into a shared investment. And most importantly, it creates co-ownership.
And that's the key. Linking the employee's prosperity directly to the corporation's performance. It fosters that faith and cooperation the new leadership demands.
It's just enlightened self-interest. You gain more by giving workers a stake than by hoarding every single cent of profit.
Okay, so let's bring it back from the organization to the individual. None of this works without self-mastery and, critically, the mastery of communication.
Absolutely. Dale Carnegie's philosophy is presented as this crucial tool for financial advancement. The ability to influence people, is a direct path to a higher income,
And they put a specific value on this, right?
a remarkable value. The texts state that if you can increase your ability to influence others by just 2%, that day will be the most profitable in your life.
Mm-hmm.
Communication isn't a soft skill, it's convertible capital.
That is a staggering claim. It puts those skills right up there with technical expertise.
Because if you can't convey your knowledge or your purpose, that knowledge just stays latent. It's non-convertible. And the cost of not being able to do that is, well, it's painfully clear in a job interview story they share.
Right, the candidate who couldn't name the salary he deserved.
He had a fatal lack of definite purpose about his own value. The manager, trying to hire him, says, "I'll pay you exactly what you're worth."
And the candidate panics.
Completely. He claims he was actually being paid more than he was worth at his last job, basically devaluing himself right there on the spot. He couldn't articulate his own financial value.
He failed the self-assessment test. He had the skills, but not the required capital assets of clarity and a definite plan.
If you don't value yourself, the market certainly isn't going to pay a premium for you. It really highlights how self-belief or faith is the ultimate internal lever. We're told that the thoughts that dominate your mind eventually translate into physical reality.
And this isn't just wishing.
No, it's about conditioning your mind to accept and pursue a definite purpose relentlessly. And we see this taken to an extreme with Napoleon Hill's deaf son.
It's an incredible story.
Hill gets this devastating diagnosis for his son, but instead of accepting it, he instills what he calls a harmless lie in the child's mind, that his deafness was a gift. A gift. This psychological frame forced the son to develop unique advantages, radical self-reliance. And that belief, backed by his father's purpose, created profound material results. The son succeeded far beyond anyone's expectations.
So what does all of this whole apparatus of personal philosophy and corporate strategy, what does it say about the bigger American economic picture?
The sources are very strong defenders of the American capitalist system. They argue its opportunities are unparalleled. And they say wealth accumulation is directly tied to obeying the law of economics.
Which means?
Because the fundamental laws of cause and effect applied to finance and industry and developing these 13 principles of success.
So in their view, people who fail and then blame Wall Street or big capital.
They're simply refusing to follow the fundamental laws that create prosperity. The system is available to everyone, but the personal discipline to actually use it is rare.
The required capital isn't just money, it's psychological clarity.
And strategic clarity, yes.
Which brings us to our final takeaway. I think the deepest insight from all of this is that the most powerful economic lever you have is, well, it's internal.
Completely internal and psychological.
Financial success is less about external market conditions, though they matter, of course, and more about cultivating that psychological capital, that definiteness of purpose, persistence, organized planning.
You see it everywhere, from Darby's eventual success to Schwab's corporate genius. The difference between those who consolidate capital and those who lose it is often just a matter of resolution and timing.
And that idea of a collective, courageous decision.
That's how the entire American system of economic freedom was born.
So that's our final provocative thought for you to think about. The source material elevates the act of decision to a matter of state power. They cite the Declaration of Independence as the result of a brain trust of 56 men making one single high-stakes, unified decision.
And that collective resolve birthed the whole American idea of economic freedom.
So we'll leave you with this question. What long-delayed, courageous decision in your own life or in your career is waiting right now to unlock your next level of achievement? Because in this pursuit, your most dangerous opponent is always time. And as the philosophers remind us, he who plays against you is time.